right, Mike, great to see you again on our Friday discussions. He says, I think you had a nice explanation of signature tool usage for long calls. I cannot find it. Where in the archives is it? Signature tools for long calls. So, oh, that's called the long option finder. I think is what you're referring to, Mike. Let's see here. Oh, and okay, this is a different discussion here. So the one discussion I may have had related to the signature tools, Mike, on PowerOptions. And if I was talking about long calls, I was using the long option finder. I don't think this was where we were talking about the volatility skew. I think this was the long option finder. That's usually where we talk about it. And so you can screen on the archives for just long option finder, and you'll be able to find that. Now, Mike adds a follow-up comment similar to what Butch just asked. Oh, tongue twister there. Mike says, am I correct that the selection results are more effective for selecting call options 3 to 5 months out, not 1 year out? That's a tough one because it depends on your expectations going forward. Here's the long option finder. I'm going to stick with Apple because it has further expirations that we were talking about. Now, what this tool does is different than trying to project. I'm sorry, what this tool does is different trying to say, okay, which long call farthest out do I want to buy and deepest in the money because I want to mimic stock ownership. What the long option finder tool does is if I had an expectation that the market was going to be bullish, this is not a recommendation or suggestion. I'm not saying I think the market's going to be bullish in the next 30 to 40 days. I think it's going to be choppy, but who knows? Stimulus passes, we see another jump in the market as we did today from the jobs report and other indicators. Too many things are taken out of the stimulus and it passes, the market falls because the market didn't like what was taken out or kept in. Who knows? You know, it's almost like an earnings event we're going on here. The Senate's kind of putting us through an earnings event with the broad market. We don't know the outcome and how the market's going to react to it. In any case, long option finder. I'm interested in Apple. I think it might hit 135 in the next 40 days by April 1st. Okay, so my expected price is 135. I'm looking to invest maybe 2,500 into options on Apple, and I think it's going to hit this by on around, okay, let's call it April 7th. Okay, so I submit this. And what this tool does is it goes out and looks at every available option for Apple. And what it did is it calculated for me which option would give me the best, highest return if the stock hit the target price on my target date. How did it do that? Well, it looked at every option that expires naturally after my target date of April 7th. Why? Because if I don't think the stock's going to hit 135 for April 7th, buying the March options now wouldn't help. So it's looking at everything after April 7th. So you've got your April 9th expiration, and we don't see any others because these took up the top results of the highest return. It did calculate, though, every call option on the chain after April 7th, with an expiration after April 7th, excuse me, and calculated what those options would be worth if the stock was trading on 4.7 at my target price. Okay, why am I not seeing January options, January options, those June options we were looking at? That's because they'd be nowhere near this return. You might see a 30% return, a 40%, a 50% return with that small movement in this small time frame for something that's so far out in time and deep in the money. But it's not going to be 170%. It's not going to be 160%. Is this accurate? I mean, how can we project that this would be 173%? Well, I think it's very accurate in the sense that the first one here is the April 126 call, trading right now at 330. And with my 2,500 investment, I could afford to buy 7 contracts. Apple's trading at 135 on April 7th expiration, 2 days away from April 9th, and I've got a 126 call. Yeah, that's going to be worth $9. It's going to be intrinsic at least. So that's a fair assessment of a Black-Scholes value, and that gives me the highest return at 173. Now, why am I not seeing more, again, further out in time if this is such a good idea to buy further out in time leap options that are in the money? And Mike, this answers your question. Is it better to buy 3 or 5 months out? It depends on your expectation and your target. So if I go up to 145, but I think it'll hit 145 by August 10th. Okay? Not too bad. It's the September calls. Here's an October call. Why am I not seeing, again, Mike, the Januaries or the Junes we were looking out for Butch? Because they're not that high of a return. It'd probably only be a 30, 35% return, not 78, 80, or 90, because of the higher cost, the higher time value, or the deeper range in the money. And here's another assessment. All of these options here with my further out expiration are all in the money. Why am I not seeing the cheaper out of the money 135, 140 calls on Apple right now if I have an expectation it's going to hit to 145 on August expiration? And that's because the September series, there is no August series for Apple right now. That's why we're not seeing any August expiration. We don't have any August ones right now. They'll be released after other expirations. But the September, okay, do I have a 130? No, I have a 125 and it's priced at $11. Okay, and of course, so if it's trading up there, 2072 with 1 month to go, that's a reasonable price. The 135 might be priced at $8, maybe $6. So if it's at 145, we're not seeing a profit as high as 88 or 87%. The out of the money options aren't giving us the highest return. That $5, or right now, let's say the September 140 is worth only $6. It's got to be worth $5 intrinsic. Let's just give it a $6 price. Well, if the stock's at 145, that's a loss. It's only going to be worth $5.10, $5.20 with 1 month to go. Maybe a little bit more. But you see, that's going to be a loss. Even though it's cheaper, it's not the best one. That being said, I projected in August 10th, Apple might hit 185, a higher range, a much higher increase in price. Which options are going to give me the best return? It's going to be the 140, 145, 150, 160, 165. Those cheaper options are going to have the highest percentage return because this is such an exaggerated increase. Okay, $60, a 50% increase by August. So yeah, now the out of the money options start showing the best returns. Normal market expected growth, 5, 6, 7% in a 30, 60-day period or 40-day period, the first one we looked at, going up to 145, so almost a 15 to 20% return in 4 months. That's logical. That's reasonable. And which options were giving the best return? Slightly in the money. Not extraordinarily deep in the money, but slightly in the money gave us the best return. That's what we see consistently. But when you expect a much higher gain, 50%, 40%, that's when you start to see the out of the money options with the highest return. Now, this, of course, is taking into account that other factor, Mike. And you can say, well, if I bought a June option today cheaper at the 145 strike, and by April, the stock moves up to 145, that's going to be very profitable. Right, but that's not what we told the system to do. The system is a calculator. We said if it's trading at 145 on or around 810, not before it, not 30 days from now. If I wanted to be 30 days from now, I would have chosen 30 days from now, as we did in the first example. So yes, you could still profit with June calls. You could still profit with July calls of this year. You could still profit with the April calls, as long as the stock has the movement prior to your expiration. Because what are we doing? As we know, we're fighting the time value. Let's take a look at your question. I think you're asking in another light, and this relates to that 1/3 concept we talked about for Mike for the options related to the time decay. Apple again. Oh, sorry, folks. And we're going to look at the, we're going to look at the April 9th expiration. Okay. And we saw that the 120s, I think, was the top 126. Oh, the 126 was out of the money. I apologize. Yeah. So we said if we bought the 126 call for April, and then on April 7th, the stock was trading at at 145, what would our return be? Okay, so we came down here essentially and said, okay, if we think the stock's going to be at 145 on April 7th, okay, that was, $1,500 profit, so that was showing us the percentage return, that 200% return, okay? Now, what if the opposite happens? We said we plugged in a $20 growth. Did I say 130? Oh, I did, didn't I? I said 135. I'm sorry. That's why it looks so high. I apologize. Thank you. 135. There we go. 577 profit in that case. Okay. Now, we're 14 points up roughly. What happens if we drop $14 in the first 30 days? I'm sorry, and the stock goes down to 107. Essentially lost everything. Okay, so we saw a monetary gain of $557 that included the cost. Liquidation value was higher, and if it drops that direction, we lose everything because we're in a shorter time frame. We're in that 30-day time frame of the time decay curve. Same scenario. Let's buy those September options. We can't keep the same strike in this case because we don't have a 126. We do have a 125, and that's what we're going to use. And we're going to buy one. Okay. And again, let's see. So we saw the return that we wanted. Here's that further out, not deep in the money that Butch was talking about, but we're further out in time. And what happens if our stock goes up to 135? Remember, we paid roughly, was that 1088? Okay, sorry, folks. We do the 1088. Nope, not 614. We get our movement to April 7th. Goes up to 135. Okay, here we go. Now see here, we see a $709 profit. Instead of a monetary profit of 557, but percentage-wise, that's lower. Remember, our cost on the shorter term, Mike, 3 to 5 months out, we were actually only 45 days out with this movement to April 7th. In that case, we paid 330 and we're seeing a profit of 500. Here we're starting off at 1088 and we're seeing a monetary profit of 709. We're seeing more monetary profit, but not as high percentage-wise. But on the flip side, if the stock fell to 107 on that same date, we would have lost all $330. No, there's no way that's right. Oh, it's the 125 call. Okay, so yeah, so it goes out of the money. So here also, you can tend to lose more. But let's do the correct, what am I talking about here? Let's do the correct one. So here's an out of the money. We started out of the money, paid a high time premium. We're effectively at the wrong side of the time value curve because we're really at the money, Mike, in this case, with the 125. And the stock fell, and we lost 664, double of what we would have lost on the shorter term. But if we had started much higher price, in the money, wow, that's almost intrinsic. That's $4. Okay, well, I'm going to use it. We're going to buy the 100 call, as Butch said, deep in the money. Not far out in time as Butch was thinking, but we're going to do it this way out to September. Okay. And we're going to go down here again. Naturally, if it goes up to 135, we might see a higher monetary profit, but what do we know? It's going to be lower percentage-wise because we paid $25 for this call. We gain about $1,100, so we see a 50% return. That's why we didn't see a lot of deep in the money ones in that analysis on the long option finder, because it's only about a 50% return, a little bit less. Stock drops to 107. And you lose about 1,100. Okay, well, I guess that means that's about right. Yeah, it'd be $7 intrinsic and then another $700, $800 to the time value, okay? Now, this is interesting in another facet as well that we'll talk about. This implied volatility of 0.3859 for the September call, that's the actual implied volatility of that September call, is lower than the SIV, which is the average near term in the money and out of the money calls and puts in this as well. This little exercise here actually didn't illustrate what I wanted. What was I trying to illustrate is that normally when I buy an option that's just 30 days out in time, and we see that 5% decrease, we did much more. Okay, we took it down 14 points, so we dropped a little bit more than about 10%, but that's okay. So what you normally see is that 126 call for April lost its full 330. And this one here loses about 1,100 because of the higher cost, and it goes down to 1449. So you're down about 50%. You're down 100% here. Many times when we run these examples, you literally see the opposite. And I know September's only 100 and some odd days out in time, but if I buy a leap option that's at the money, and I buy a 30-day out option that's at the money, if the stock moves down 5% in the first 30 days, this goes to zero or goes to 20 cents. So you lose that $3.20, $3.30. Whereas this one that's 180, 200 days out, you only see the loss of maybe $1, maybe 80 cents. The time decay curve in action. This one actually showed us the opposite. And that's because we decayed. I did do that wrong, I'm sorry. Without the change in price, stock stays the same at 121.50 to April 7th. We lose 40 cents on that farther out option. Stock stays the same price, 121.50 for 126 April 9th expiration. How much are we going to lose? 330. So comparing the same strike options and what they lose, that's what the ATM bell curve shows us. We know that April 9th expiration at 126 that we paid 330 for, if the stock is trading at 121, stays at the same price on April 7th, 30 days away, this is worth 5 cents. You've lost almost everything. Whereas that leap option or that further out has only lost 30, 40, or 50 cents. Okay, that's the time decay curve in action. So Mike, I stumbled a little bit on that one. I'm not sure if that's exactly what you were looking for, but the long option finder, you'd mentioned signature tools and the long option finder, that's the one that helps us identify which is the best option to buy based on our expectation going forward. Then we sort of took a step beyond that and we looked at, well, if I'm only expecting a normal market, why am I seeing slightly in the money or slightly out of the money options and not very far out of the money options or very deep in the money options? And it's because the tool is designed to show us the option that would give us the highest return. Naturally, if you expect a much larger movement in the stock, that 40 or 30% gain, then you'll start to see the out of the money options that are cheaper having the higher expected return. But in normal market conditions, it's a little bit slightly in the money, at the money, that give you the best return for your projections. You don't see the deep in the monies because, again, the cost is still too high. And yes, you get a one-to-one delta, but percentage-wise, you're not seeing the higher return. And we tried to illustrate that with the custom spread tool. And then I didn't show at first the proper representation of how the at-the-money bell curve reacts. It's if the stock stays at the same price when you're buying those shorter term options, as we saw, 30 days, 60 days out. If the stock stays the same, you know that you're losing the full amount because everything you paid is time value. Most of what you paid is time value. Whereas farther out in time, you're only seeing a decay of 40, 50, or 60 cents, not $3, $2, or $4. Okay. Fernando has a thought on this too, of course, and thank you, Fernando. It's good to see you here. He says, for long options in quality stocks, Apple is a quality stock we'd consider, although tech's been getting hurt recently, but even Microsoft, Apple, quality stocks, Johnson & Johnson, things of that nature. In any case, Fernando thought, says, I always prefer to buy in the money at 70 delta, 6 months out in time, because I really don't know if my expectation will be right. So I prefer to get more intrinsic value, buying the 0.7 delta, maybe a little bit higher, but we saw the risks of going to too high of a delta of 0.9 or 0.95 and paying into the less time value. And that's accurate. That's what we were talking about with Butch earlier, Fernando, in relation to looking at the higher delta, but be concerned of going too deep with that higher delta where there's no activity, no open interest, no volume, and you're setting the market for it as well. But in Apple, of course, we didn't see that problem. But you're right. Deeper in the money you go via the ATM bell curve. Well, let's just talk about calls. We're not talking about the puts here, but they're similar. So when you're in the money here, you're paying a lower time value, but your cost is higher because the intrinsic value. But you have if I go 3 months out in time, I have a lower cost per day than buying the 1 month out, than having to buy the next month out, than having to buy the next month out. This is not 3 times the cost of the 1 month out option. Fernando, as you mentioned, the 6 month out is not 6 times the cost of the 1 month, and it's not double the cost of the 3 month. It's much less. And then, of course, so going in the money, 0.7 delta you had mentioned, 0.8 delta is a good range, I consider. You get that value you're paying is the intrinsic. There is some time value, but it's much less than when you're in this range. But we saw, Fernando, you said because you're buying farther out in time, expecting a move shorter term. I'm sorry, not shorter term, excuse me. But you have an expectation. You're going 6 months out because you don't know if your expectation is going to be right. But when we use the long option finder, we said what we were showing is that if your expectation is that in 20, 40 days, you might see a $10, $12, $15 gain on your stock, that tool will show you the best option to buy if you're targeting the highest percentage return. So you don't have to do it manually on an option chain or another tool. Okay? It's doing all of that heavy lifting for you that, yes, if your sentiment comes true, these options will give you the best return. And we sort of just discussed a little bit, why am I not seeing the deep in the money when I'm expecting a move of 10%, 8%, 30 days at a time? Why am I not seeing the cheaper out of the money ones? Well, the cheaper out of the money ones in our example, when we said Apple might go to 135, of course, in 30 days to April 7th, we know of course that the 140 call is probably the cheapest one right now. I mean, the stock's at 121, so the 130 call is going to be really cheap. But it's going to be less than $5, so we might see a $4 profit on the position because you're still going to have to pay about $1 for that 130 call, and it goes up to 135. Hey, you've made $4. But it's not seeing as high as a return. What is that? I want to see the option chain there. What is that? Oh, is it even on my list here? It got close. Oh, yeah. See, the 129 for April 9th is 233. So the 135 is probably going to be around $2 or $1.80 for the 130 strike. So you get a $3 profit, a $3 return on $2 investment, but it's not as high percentage-wise as these others. That's why it's not coming up. I bet you if I go to 140, the 130 or the 135 call is going to be one to buy. Yep, 131. How about that? 183, highest return of 392. There's the 130. But I needed more of a movement to see the profit in that 30-day time period because it would give still a profit, just not as high as a profit as the other options. And that's what this one is showing you. Of course, and then for Mike, the conversation related back to the ATM bell curve in addition to the time decay curve, in the sense that, yes, I do want to buy further out in time, but if there's a large movement downwards, remember, if you buy further out in time and deeper in the money, you have a higher cost. If you see a 20 to 30% drop, you still may be losing 50% on your in-the-money call. And that's what we saw, that the 107 strike, no, the 100 strike, excuse me, we would have paid $25 for in September, dropped down to a value of about $1,100, $1,200. So we lost 50% of that option with roughly a 12%, 15% move from 121 down to 107, a $14 move on a 120 stocks, around 12, 15% decline, put us at a 50% loss on the long option for September. And the out of the money option for September, it would have been slightly higher. We might have been around 60 or 70% loss because we've lost all that time value that we paid and we've essentially got nothing left. Okay, well, ladies and gentlemen, it's 5:47 p.m. Eastern time. I don't see any other questions directly that have come in. If anyone has any last-minute questions, go ahead and send those to us. We'll be more than happy to take those in the last couple of moments here. But while we're waiting to see if anyone Ah, there we go. Well, I'm sorry. While we're waiting to see if anyone has any last-minute questions, I just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Options do involve risk, may not be suitable for all investors. And we covered some of those risks with the different structures of long calls today, as well as some of our other discussions as well. Now, if you like some of the tools that you saw today, we didn't get a chance to look at the portfolio, but we ran a search using specifics, looking for ETFs with high average stock volume, relatively high implied volatility, and how to remove some of the leveraged ETFs. We looked at some of the signature tools, thanks to Mike's question related to that long option finder. By the way, if you're expecting the stock to go down, you put in a value that's lower than the current stock price. You will see options, of course, you will see the put options that are the best to buy if you're expecting a downturn also. And of course, we saw some of the other features, but if you haven't done so yet, just go to powerop.com, put in your name and email address. You'll have full access to all of the search tools and all 23 different strategies, the research and analysis tools, the signature tools tool, including the long option finder and others. Of course, the portfolio tools for tracking and managing your positions as well, and much more. For 14 days, no credit card required. Just go to powerop.com, put in your name and email address. After that, the monthly subscription starts at only $45 per month, but that is for end-of-day data. It's only updated at the end of the day. We do have a 12 to 15-minute delayed service. That's $65 per month. Of course, we also offer a real-time service and historical data access as well for different price levels. Mentioning what we talked about with Mike, you see here you can get the free education in various places. If you go to powerop.com/webinars.asp, you'll be able to go through the tools, strategies, options, concepts section. Mike, I think the last long option finder discussion we had prior to this one is under the Power Options tools section. It's about the 5th or 6th one down, if I'm not mistaken. Of course, you can always go to YouTube, as we showed a little bit earlier. You can look at all the different videos there. It shows the recent ones, but there was that search function. So you may just be able to search for long option finder, calls to buy, buying calls, Mike, related to the long option finder tool, and you'll be able to see any of the other presentations there as well.